Welcome to the David Lott Show, where we guide elite entrepreneurs from earthly success to eternal significance. Hey, can you help us grow? Please like, comment, and subscribe to our content.
I'm super excited to talk to you about the topic today.
Well, I better do a good job because this is what I'm supposed to know about.
You are the professional.
It is debatable whether I have any credibility in anything I'm saying.
People watch this and have assumptions on your skills as a human being and as a financial professional.
This is theoretically what I do it is not theoretically. This is what I do for a living. So either I do know what I'm talking about or everybody who works with me is.
We're about to find out.
Yeah.
Real quick. So what we are talking about is the market outlook.
Oh, that's comfortable.
Yeah. Everybody loves the stock market.
Yeah.
You know, specifically when it's going up, not so much when it's going down. Right now, I mean, there's, I guess you could say, emotional turbulence in our society of people have a feeling of things aren't going well, but then you look at the stock market and it's at all-time highs. And there's this, you know, not balance, but it's kind of a tug between those two things. And maybe it's headbutting of emotions with reality. I don't know. There's a lot of things that go into that. I'm interested in your broad perspective on where the market is right now, and then we'll dig into kind of the outlook as we go on.
I think it's interesting to point out the reality. This is like the John Madden, all you got to do to win the football game is score more touchdowns. Companies globally, particularly in the United States, are more profitable and have more revenue than at any point in the history of mankind, which is why the market is at all-time highs. And I think it's an important fact to point that out because sometimes people feel like there's some funny business going on with stock prices and companies and the trend of markets. And maybe sometimes there is funny business going on. But the fact of the matter is companies are valued based on revenue and profitability, the current status and future expectations. And then people put their money and place their bets based on, you know, trying to take advantage of those further opportunities. And so it's real money, it's real people, it's some robots, and ultimately it does create a level of efficiency. And so the market is representative of what's happening. And I think that's important as a starting point. So the market's in a great spot. And how we got here was many years of technology changing the efficient frontier of what's possible when it comes to productivity and profitability. And now we're in a whole new wave of that with AI. We have been riding the AI wave, the thought of what could be since about 2022. We came out of inflation and heavy money being injected into people's pockets, which drove up the Mag 7. Everybody was online shopping. You know, I was looking at dirt bikes on Facebook Marketplace and people were selling them for Lamborghini prices, right? I mean, it was insane how much money went into anything that you could buy online, consume online, one way or the other, coming out of COVID, of course. Mm-hmm. We had huge inflation as a result of that. The Fed raised interest rates at the fastest in history, and that slowed things down a lot. Certainly hurt tech stocks. Tech stocks were down, depending on what you were looking at and when you were looking, anywhere from 35 to 50%. And we've since rebounded with the advent of artificial intelligence, ChatGPT, et cetera. So where we're at today is many years of great returns. And there's this push and pull between what could be all this infrastructure spending and promise of the future and what is, which is show me the money. You know, where are we making money on this so far? And it's most relevant in the largest companies who are spending the most money because the top 10 companies in the S&P 500, which SpaceX is now one of, are roughly 40% of the 500 companies in valuation. And so there's this hyper focus on all the money they're spending in an arms race to try to take over the world, really, where they used to kind of have their own thing. Amazon sold stuff online. Facebook provided a social media platform where they could sell ads. You know, Google was the search engine. Microsoft was the infrastructure for software. So, you know, similar to Apple, they had their own ecosystem. Now they're all competing for kind of the same thing, which is very interesting and in some ways probably zero sum game. So the future is uncertain. So that's kind of where we are and where we're going. Where we are at, like if we really zoom in, market's up 8 or 9% year to date,
Mm-hmm.
which was better, which was what most people were expecting for the whole year. So targets on the S&P 500 coming into this year were in the mid 7,000s. We're at about 7,500 today. We've been up almost to 7,700 so far this year. And now the expectation is starting to kind of get a little frothy in terms of people are starting to feel like, oh, this AI thing could keep going. We're about to have earnings. In fact, SpaceX just announced that they're going to report earnings here at the beginning of August, which is going to unlock a bunch of Tesla employee shares that they can sell, and others who participated in the funding rounds pre-IPO. So there's some optimism there. Where I'm at is I'm looking at how good things have been, and I'm also just looking at statistically. A lot of times we look at other factors in the market, maybe technical analysis, maybe interest rates, maybe economic factors to try to point to where either economic or, like chart trend-based factors, momentum-based factors on where the market's going to go.
Mm.
But where we're at now is, I believe, a point where we have to start to look at statistics of market corrections. How often do these things happen? About every 4 months, 3 times a year, we have about a 5% correction in the market. It's actually called a pullback. It's not a correction unless it's greater than 10%. Every 18 months or so, we have something greater than 10%. About every 3 years, historically, we have a 15 to 20% event. And then, in the 4 to 5 year zone, we have something greater than 20%. Now that's historically, that's going back to 1940, 1950. If we look in the last 10 years, we had a 20% correction in 2018, greater than 20%. We had a greater than 20% correction in 2020. We had a greater than 20% correction in 2022. We almost hit it last year with the tariff thing. We were, I think, intraday down more than 20, but we closed down 19. So we've had a lot more volatility, and volatility is ramping. All that to be said, I would say my expectation is we're going to have a correction of some sort within the next few months. That is because we are just starting to get a little bit long in the tooth from the last one, which was last April. If those 10% or greater corrections happen roughly every 18 months, we're starting to get into that zone. And knowing that they're happening more frequently than they used to, it wouldn't be a surprise. So what are the things that are pushing and pulling, making that the case? One is geopolitical. So we are at war with Iran again. That doesn't tend to have a lasting impact, but it just shows you that there's volatility associated with things being unsettled in a global space. It could just as easily be a tiff with China or some other country. It doesn't have to continue to be Iran. But because it's in the Middle East, that's causing oil prices to go up. Oil prices, honestly, are not that much higher at the moment. They did go higher, but then they came back down. They're not currently that much higher than they were before going into Iran, but that higher elevated oil price, which seems to be trending up again, is causing inflation to be higher in the United States. So geopolitical risk, oil goes up, and now where we had a Federal Reserve that was looking at trying to be more accommodative with their monetary policy coming into this year, are now starting to have question marks, especially with a new Fed chair, of should we keep rates the same? Should we raise interest rates? Why does that matter? Well, AI is all about the promise, and growth stocks, technology stocks, are all about the promise of the future. If we get into an interest rate environment where they're hiking interest rates again, now the playbook goes back to 2022, where value stocks that pay you cash today so that you can invest them at higher interest rates, all of a sudden become the place to be again. And now, the AI trade significantly falters because those dollars invested in companies now in technology, whether it's chips, whether it's software, whether it's AI infrastructure of any kind, large language model providers, those are all long-term bets with no cash flow in the meantime, no dividends. If we get to rising interest rates again, it's going to be about dividend stocks. And that whole narrative could change very quickly. So there's a lot of things that are interconnected: geopolitical, connected to oil, connected to inflation, and inflation and interest rates connected to what types of stocks are working: growth, which are, higher revenue growth potential with less current benefit dividends, versus, let's say, something like Caterpillar,
Mm.
you know, kind of that old world economy, big physical infrastructure, machines, businesses that are higher cash flow, that do pay dividends, that you can invest at higher rates. So that's kind of what's going on. I believe that, and I'm really just going and going and going here, but to try to go towards a bow, I believe that we will have a correction in the next couple months, followed by another big run up. My concern is that next big run up could be the big one, would be my concern. I don't know,
Yeah.
but I could create a scenario where that could be true.
I am what would probably be considered like an average investor type person. I don't work in financial industry.
What does that all mean to me?
Yeah. So, tell me, what do I take away? Because a lot of times, you hear these terms like, just, invest monthly and, don't try to time the market. It's all about time in the market, not timing the market. How do we make sense of the market when there's all this chaos going on and surrounding us, and we hear it in the news and it's on our phones, we see all this craziness? Like, there probably becomes a tendency to want to protect what we have. How should we look at this more of an objective, not emotional state?
Wow. So I think, let's see if we can try to break that down into 3 tranches. Tranche 1 would be active management versus passive management. Conversation 2 would be the risks of just indexing like everyone's doing. And topic 3 would be, what are you trying to solve for with your investment? What's the end purpose? Which would tie back to what you said. Shouldn't I just set up an automatic drip and let it ride? Which is a way to win over time. So conversation 1, since 2008, the market has basically been in what's called a momentum trade. And that means that what's working is continuing to work and just better. So if you look at the biggest contributors to the S&P 500's performance, roughly 50% of the return of the 500 companies. So the total value creation of those 500 companies, about half of that total value creation going back to 2008 has been from the large tech stocks that everybody knows: Facebook, Apple, Amazon, Microsoft, Google, Nvidia, more so recently, Tesla. And that has made index investing the best thing on the planet. Because index investing, there's nothing active happening in terms of saying AT&T is better than Verizon and Microsoft is better than Apple. There's no decisions being made like that. It's purely whatever that company's doing on its own merits is going to rank it. And the better it does, the higher it gets ranked and the more of the portfolio is represented there. Mm. So it's very cheap to manage a portfolio that way, which is why you can buy an investment from BlackRock or State Street or Vanguard, where a lot of people do, or Fidelity or Schwab or any of these other places for next to nothing in cost, and get great performance. And it's not even quotes, like great performance. I mean, market returns over that time have to be close to 15% a year, right? Maybe better. So the alternative to that is paying for active management, where you give your money to somebody and they go do their own research and they say, well, I think that this company is better suited than that company. I think that Hilton is going to outperform Marriott. Here's the reasons why. I think McDonald's is going to outperform KFC. Here's the reasons why. I mean, just go down the line, right? You're overweighting and underweighting based on, different factors. Maybe it's the quality of the business, quality of the management, quality of, the opportunity, maybe momentum and not momentum, but technical factors of the stock. There's a million ways to look at it. Yeah. But that's more expensive because now you have somebody going in and doing research to try to make those assessments for you.
Sure.
That is not done as well when 7 companies have been, those people are looking at the 500, and when 7 have been creating all the returns, there's not a whole lot of value in that person doing the digging.
Mm.
So for the everyday investor, most people's investments, because of where the 401k market has gone, the retirement provider market has become super cost sensitive. So has the entire investment community, but particularly in 401k plans. And so any person, either in the advisor seat or the employer seat, has been extremely incentivized to offer the cheapest thing possible. And the cheapest thing possible are indexes. And it just so happens that those indexes have worked very well. It's not been to offer mutual funds that are more expensive and have active management. Okay, so everybody's into index funds, and that's been great. What's the problem with that? The problem with that is then you end up in the same boat if we have a dot-com bubble that everybody was in back then. You had a similar environment where the largest companies were a huge market share, and we didn't have index products being utilized to the same degree. But what happened is everybody got crowded into the same stocks because they were going up in value huge every year. And then when the bottom fell out, everyone got crushed. So for the average Joe, one thing that you should be concerned about and thinking about is, oh, well, I'm very diversified. I've got an index that has 500 companies. Well, not exactly, because half of your portfolio value is in the top 10. What happens if those top 10 change? Even as simple as what happens if those top 10 change is a great question to ask yourself, because the top 10 years ago and 20 years ago and 30 years ago and 40 years ago are completely different.
Right.
So that is a real risk. And as we head towards our next big downturn, which will happen eventually, if everyone's crowded in the indexes, that's a huge problem. And that will cause major losses. Now, to the third point, if you have all the time in the world and you have 30 years to recover, you don't care, because you just keep putting money in, you're buying when it's down, and we all know the market goes up over time. And even in those indexes, the leaders will change over time, and you'll be able to recover your money and you'll be able to move on. The challenge is if you have goals that are shorter term than that. What if you want to buy a house? What if you're looking to retire? What if you're looking to have a safety net for your business when the economy's hard? That is when things start to get more critical to match risk, volatility, diversification, and how you're going about things in a way that may not just be purely seeking the highest return potential. Now, the highest return potentials in the last 15 years have also been the highest outcomes. That is not always true. Risk is like a bell curve, if you remember statistics class from high school. And when you have a bell curve, you have an average return outcome, which is the middle line of that bell curve. And then you have a bunch of dots, which are instances all around it. The instances that we've been largely experiencing in the last 15 years have all been on the positive side of that return bell curve. Eventually, we have to have outcomes on the other side to balance out that mean or that average outcome. And that would be the risk in an index fund. So not that they're bad, everything is a tool. And so as an average investor, I think it's important to understand how what you own works and be able to understand, hey, maybe I'm not as diversified. So one way that you could consider looking at more diversification is starting to balance maybe more intentionally between growth and value, even indexes. Another way would be to balance between size of companies. If you own the S&P, you own huge concentration in companies with the largest values, the biggest footprint, maybe there makes sense to diversify to smaller companies as well. Both of those things have been working this year. The other thing to consider is to diversify to companies outside of the United States, maybe to diversify to other asset classes like precious metals or commodities, potentially real estate, right? Like just broadening out what you're invested in and being thoughtful about that. So that is a long answer to a short question, which maybe because I'm not Einstein, I require to be able to get my point across. But a lot of times the answers to these questions are a lot more complicated often than they may seem.
And they're very specific to the individual and their situation and, what their goals and their desires are.
That's right.
Is there
and what's interesting about that point is that everybody measures success the same way, cost and outcome. And yet everybody's goals are different.
Right.
So that must mean that cost and outcome, like highest return potential, can't possibly be the right formula for every person.
Mm. Yeah. What variable are you solving for? Because there's the time aspect in it as well. Like you said, some people want to save up to buy a house.
Yeah.
Well, what's the timing look like? Because if you're going to buy a house in 3 years, but you know that you wait 7 years, your returns are going to be higher. Like there's other things to be solved for in those equations.
Well, think about it this way, and this is a very important point, and we could cut this into a little reel here. When cost and performance are the two most important factors when people are making investment decisions, you have to ask yourself, why is the performance so good? Because if it's been so good, that means it also has the potential to be so bad. And if cheap is the best, well, the reason it's cheap is because it's simple. And is simplicity the best way to always approach investments when markets become more advanced or become more technical? And so just know what you're buying, right?
Yeah.
The reason it's cheap is because it's very easy for that provider to make that thing. And yes, it's been working, but might there be other options in the future that might be more costly in terms of how people are measuring costs, which is like, oh, well, how much do I pay the fund manager? But might actually not translate to the best performance outcomes.
It's good. Is there a level of investable assets where it makes sense versus doesn't make sense to like work with an advisor versus just handling, like you said, just going with index funds? Is there a level where it makes more sense?
There's a lot to unpack in that answer. I think what I would say if I was to make it simple, I would just measure it based on your tax bracket, because there's so much performance advantage to be gained in paying less in taxes when it comes to actual net worth building, which is what we're ultimately all trying to do. Like nobody wants to make a bunch of money in the stock market and then give it all to the government in taxes. That doesn't really get you ahead. You have to make it and then you have to keep it. And that's what builds your net worth. So I would say once your income gets above maybe $150,000 or $200,000, that's when you might consider talking to a financial advisor.
Is that individual or household?
Household income.
Okay. Let's talk about trust. Because our society is very fear-based.
Mm-hmm.
We feed off of negativity for some reason. It almost, makes us feel, I guess on one hand, it makes us feel like, okay, it's not so bad for us. But on the other hand, it makes us feel like we're all kind of going through this together. So talk to me about a fear-based versus a faith-based perspective when it comes to, personal investing and business investing and having a plan for the future.
So let's look at fear and faith as a spectrum. And then let's kind of substitute some words. So let's substitute fear, let's say that's control, and faith, maybe lack of control or yielding complete control.
That's a good word.
And so I would argue that both of those ends of the spectrum shirk your responsibility or take too much. The fear side, which is the control side, like leads to control, that's taking God completely out of the equation. And the yielding or, faith too far side is taking you out of the equation. And God didn't intend either of those to be true. He didn't put Adam and Eve in the garden and say, lounge and eat the fruit. He said, take care of it. This is your job to reign over. I've been learning a little bit about, and shout out to Garden City, that book, just learning a little bit more about how God intended us all to be kings and queens on earth and to reign over what he gave us, which requires our input and requires not shirking all of our responsibility. So when it comes to investing, I think you have both of those ends of the spectrum. You have the person who is trying to control all the outcomes, and fear is usually the center part of their narrative. And then you have the person who has no idea how much they're spending every month, is just kind of like, mailing it in and hoping for the best. And those probably, neither of those are probably the right approach. Um, so when it comes to investing, when we're looking at those two ends of the spectrum, here's what I see practically: the set it and forget it attitude of, I'm just going to, keep putting my money in the S&P 500 until the cows come home. Or I don't trust the market. I constantly think something's going to cause the big one. I listen a lot to guys like Robert Kiyosaki, who were very right about some things and have been very wrong about the market, and others. The Big Short, Michael Saylor, been very wrong. A lot of the big bears have been wrong for a long time. And so, like, what are the downsides to that attitude? Number one, well, the downside, candidly, to both is creating risk that's unnecessary. The downside to letting it ride and being blind to what maybe your current situation is, or being a real good steward, is that you could be creating risk that you don't realize, or not creating opportunity that you could otherwise be realizing. AKA, you need your money, market's down, is a great example of how that goes bad. How the fear side goes bad is when you're kind of in this doomsday vibe, and it's like, well, what if, the government's against us, and the global elites are against us, and Armageddon's against us, and all the people I'm reading are saying we're going to have an 80% market correction. And what then? And a lot of those people are like, should I be buying gold? Should I be, I don't know what.
Got their cash under the mattress.
Cash under the mat. So what's interesting about when you play that scenario out, really, that's like the Armageddon scenario. And assuming that you should be in cash, well, what happens if we have rampant inflation in that scenario and your cash becomes worthless? Oh, well, I wouldn't have it in cash, David. I would have it in silver and gold. Well, what happens if that scenario also involves a lot of battle and war? And yeah, you've got all sorts of physical metals to buy stuff, which may have value, but the person who lives next door to you has more guns than you and ammunition, and they just come take it from you. So I always make the joke, like, hey, instead of investing in gold, if you're worried, you should be buying more guns and ammo, because that's the ultimate negotiation. That's the ultimate buying power. Which is not, necessarily a place where Christians probably want to go. So I think that prudence is somewhere in between. And I don't know if we should be betting on the end of the world all the time. We should have an eternal mindset, and God's going to take us home when he wants to. And we know the end will come, but we are supposed to be working the land in Babylon, just like he told the Israelites, like, hey, stay here, flourish, and prosper. And that is what we're supposed to be doing. We're not supposed to be always betting on the end, because nobody knows the hour and the day. So,
yeah, I like that. One of the verses we have is Psalm 112, verse 7. It says, they will have no fear of bad news. Their hearts are steadfast, trusting in the Lord. Yeah, it's a good reminder. No fear of bad news. I mean, we're constantly surrounded by bad news, and, you hear the people on the doomsday side of things that say, get your money out of the market. It's all coming down. It's going to crash, going to crash, going to crash. Well, they've been saying that for, at least as long as I've been an adult. I remember hearing things like that, and it hasn't happened, right?
Right.
I mean, since the invention of the stock market, you zoom out, it's just continuously gone up.
Mm-hmm.
There's been drops, there's been dips, but it just eventually keeps rising. One of the things that I think is so interesting is, yeah, if the worst case scenario happens, well, your money's not going to matter, right? It just doesn't, it'll have no effect on your life at that point. So why worry about it? Why stress about it?
I think that the only downside to the market just always goes up. And keep in mind, there's been significant drawdowns. .com bubble went all the way through 9/11 into 2002. I think it was, probably in a 70% market decline from peak to trough. So, and we know that other instances, for example, in the late 20s, Great Depression, similar scenario. So it doesn't matter until it does. So what do I mean by that? It doesn't matter when you're young and you don't have any money and you're not intending to ever spend it in your mind, right? It's like for the future, for the future, for the future. It does matter when it becomes a lot, you're older and you are intending to spend it. And sometimes you're intending to spend it when you're maybe 30 and you're buying a house or whatever. So I think that what's important to understand is no good decisions are made in fear. And also no prudent decisions are made blindly. That's the ends of the spectrum, fear and, taking no responsibility. So I think that, what God has told us is that he hasn't given us a spirit of fear, but of power and love and a sound mind. And that's a great barometer to be making decisions based on. And then, what becomes necessary is to have a framework of how can I diligently go through the ups and downs, be invested, because the parable of the talents says I should be creating a return. I shouldn't be burying it in the sand. At least I could put it in the bank. Unfortunately, with inflation, that's not really doing you any favors these days. So how can we be prudently building all the time until the Lord takes us home or returns? And I think that having a framework for that is, could be different based on the person, but is certainly core to being able to operate in a way of wisdom.
So taking a layer deeper there, you talk about having a bucket strategy for each scenario that possibly you could run into.
Mm-hmm.
What does that look like for you personally, your perspective?
I'm going to broadly oversimplify this. There are a couple components to having successful outcomes in the market. Let's just kind of label three of them. One is getting more money out than you put in. That's a successful outcome. If you get less out, that's not much of an investment. Number two is the fact that the market is unpredictable. Investments, depending on the type and risk and reward opportunity, are increasingly unpredictable. And three, you have to have some method of selling when you have a profit. Again, if you're not selling when you have a profit, you're back to item one, which is you're taking out less than you put in. And so what we use is not what we invented, but it's something called the bucket strategy, which basically assigns risk and return to different timelines, short, intermediate, and long. And based on the research that I've done, I believe that in less than a 3-year period, even though the market's probability of a positive return, the market being the S&P 500, is in the 80% range. So if you go back to any day in history and you put your money in for 3 years into the S&P 500, there's an 80% chance you're going to make money. That's pretty high. But to me, it's not high enough, because generally that need that you have in 3 years is critical. You're paying for your income. You want to put a down payment on a house. You're doing a remodel. You're buying a business. Like, it's usually big and you can't mess it up. So if you have a need for your capital in less than 3 years, I would probably have it in money market or short-term bonds. You can earn great interest right now, let's say 3 to 4%. And if you're a high income earner, let's say greater than 200,000 in income as a household, you might consider municipal bonds, because A, they're safer, and B, well, safer than corporate. And also you get a tax benefit, which is great. In the intermediate term bucket, goals that you have 4 to 9 years from now, there's a statistic out there that there's never been a 5-year period where half S&P 500 and half half S&P 500 US stocks and half US bond portfolios lost money. So you go to the highest possible peak of a market scenario and you have a 50-50 portfolio and you wait 5 years, you made money. Great. And that particular portfolio also recovered back to even in the financial crisis in 2 years. So if you have needs in the short term that you've got either cash or short-term bonds, maybe municipal bonds if you have enough income, you have an intermediate term portfolio. If you have intermediate term needs, what would an intermediate term need? Maybe it's an intermediate term goal. Maybe it's just a need to have future income to replenish this short-term bucket once you've depleted it. That is a great way to position your portfolio. Half stocks, half bonds. If you have goals that are longer than 10 years from now, that could include retirement. That could include giving your kids an inheritance. That could include charitable giving goals. Those can pretty much 100% of the time be invested in all stocks and give you the highest return and in a risk scenario where you will make money. And so understanding the statistics around how long do you have to hold something so you have virtually 100% probability of positive outcome, allows you to make sure that you take out more money than you put in. And when you have those three buckets, what it allows you to do is when market's good, let's say better than 10% in a year, you can move money downstream. So assuming that if you have a short-term bucket that's being spent, you can take profits from your long-term bucket and refill the more conservative buckets so that you're taking chips off the table when the markets are good, which is what we've been doing for years since they've been good. When markets are bad, you don't have to take chips off the table. You can let them recover. And what happens is if you are kind of spending that shorter term bucket, it is inherently creating a more equity oriented portfolio, which will rebound faster when the market turns around. So the long and short of having a great structure to your portfolio is, again, being able to be in all sorts of different types of markets, making progress, making sure that when you need your money, you have more than what you put in, and ensuring that you have some sort of method to take profits and replenish your conservative coffers. Maybe it's even an emergency fund.
Yeah, it's good. When the markets are high and you're taking that money from, let's say, your long-term to your short-term, however you describe that, is that considered rebalancing, or is that something different?
It is rebalancing.
Okay.
So that's a great point. What we're effectively saying is rebalancing. So what would be the point, or what would be the value in having separate accounts for these ideas? The value is something that's called mental accounting. What studies showed in behavioral finance during the financial crisis were that people were more inclined to not sell their investments in their 401k, but were more inclined to sell their investments, let's just say, in a brokerage account outside of their retirement savings. Why is that? Because in their mind, they're thinking, oh, well, my retirement, that's long-term. But this investment account I have at Schwab or Fidelity or whatever, I need that money. I might need that money now. I can't see it go down anymore. I got to sell. And so from a peace of mind and longevity in the market perspective, and staying in the market when things are uncertain, which they always are, is the number one risk for investors not achieving the market's performance, is selling all the time, usually virtually always at the wrong time. The way that you get around that is having different buckets in your mind. So maybe you don't have income, but you have an emergency fund, or maybe you've got a business and you've got some sort of safety war chest. And then you've got your longer term investments, just to like make it even simpler, just having two. When you know that you have both, even if they were in the same account and they would be the exact same allocation between growth and income, or long-term and short-term, if it was all in one account, having them separate psychologically allows you to be more at rest. And with our clients, knowing that they have 3 years of a war chest over here allows them to deal with the ups and downs of what's really generating all the performance. So that is how I would, that's the value of having things separate versus having it all just smushed into one account and rebalancing. Because when you're doing that, it's all in one account, and your mind doesn't know how to allocate, to different components of your portfolio. And so it creates more fear.
Sure. That was a lot of solid information. I think we got a heavy dose of financial education, I would call it. At the end of the day, we are Christians. We believe in Jesus, and our heart and our goal is to be faithful to him. How do we, as Christians, be faithful to God with our finances?
One way that we can be faithful is not trying to rush things or be too conservative, right? It kind of goes back to, those ends of the spectrum. I think having a reliable, time-tested approach to how you're investing your money, even if it's not the Sprint or it's not the bank, is the best option, because I think that God rewards that would be, in my opinion, what would be comparable to faithfulness. Faithfulness inherently suggests like showing up every day and plodding along, but making progress and doing your best. I don't know if the bank feels like that, and certainly trying to have like a short-term win, like some sort of like lottery style, outcome does not feel like faithfulness. So, and I've been learning that in my own finances too. And I think a lot of wealthy people get to a point where the money feels it gets a little bit easy to spend. And then you're kind of looking for a thrill or something, and it's just bad news. So I would say having an investment strategy that is reliable. It works well in all market environments. Things are going great. Things are not going great. You're still making progress, and you're able to continue to invest. And honestly, when we talk about investing, it's not investing towards your goals per se. It's more in God has entrusted you with this influence and resource. Why do you think you're here? And what are you supposed to do with it? Usually it's not just to buy more stuff. Actually, there's no scenarios where we talk about ambition. The ambition is to build God's kingdom, not to build our own. So good ambition. So, how can we be constantly moving forward towards the work that God's called us to with our time, talent, and treasure? And that is never all in the bank or all hanging it out there.
Yeah. So there's a middle ground to
There's
it.
a middle ground.
And we've talked about this before, but the idea that we are not the owners of the finances that God has given us, right?
Mhm.
We are meant to be stewards. Talk to me about what it means, and we've talked about it before, but talk to me about what it means to be a faithful steward.
One interesting way to think about stewardship, especially when it comes to money, I, I don't know where this came from, but I'm a car guy. So you think about a Ferrari or some sort of, muscle car or exotic car. And let's say you think about what it would take to buy a car like that on your own. Lots of hard work and saving and, looking forward to an anticipation to finally spend hundreds of thousands of dollars on this vehicle and then like baby it around, right? Like, and imagine you're going to take it to a racetrack. You're probably going to not, have all that effort, all that savings, all that time to just go hang it out there and wad it up in the first corner. So take that exact same car you have in your mind, and now imagine you're the driver on a race team. It's the same car, but it's not your car. It's their car. They gave it to you to create optimum performance out of. Now they want you to win the race, which means you can't crash it in the first corner, but something tells me you're going to drive it a lot different than if it's your car that you spent your money on it. And I think that's the important balance that is described between being a steward and being an owner. If you're the owner, you're taking all the risk and all the responsibility. If you're a steward, you are supposed to be thoughtfully managing someone else's property to achieve the outcome that they want. And in the race, they want to win. But you can't win unless you get to the end. So I think that's a fun way to think about stewardship versus ownership.
Okay, you have your financial investment firm, Carrick's. You guys have something called a faith forward framework. Walk me through what that looks like and why it's different than a typical investment firm.
The financial services industry has two lies that has permeated the entire space. The first is if you have enough money, then you will be free. And second, if you reach your goals, you will be happy. Well, I'm here to tell you that I have personally and seen many people achieve both of those outcomes. Enough money to be free and reached a goal only to find that they still weren't happy. And so then how do we solve this kind of dilemma? And the answer to that dilemma is to understand that we are beings that were created by God for a purpose. And where we get fulfillment is living that purpose. And that purpose is generally to help other people in one way or the other. And that is where we're most alive. We're built to work. We're built to create good and human flourishing by God with our unique gifts. So in order to have our finances work to that end in a way that is fulfilling, we have to first understand, why are we here? Like understanding your calling, that seems like a big ask, like a big challenging. Well, I don't know why God put me here. Well, it's a great thing to start exploring. But a different way to think about it, even more in a more accessible way than a word like calling, is why do you think God gave you all this money and influence? What is it for? What are you uniquely gifted in, interested in? What circles are you in? What problems are heavy on your heart? That is such a better way to think about our money, because once we have that direction that is bigger than ourselves, we can start to use the resources that we've been given to steward to further God's kingdom in that direction. And now the intention behind those resources is, of course, also to bless us because we are God's children, and that's just the way that things go. But they have a bigger purpose, and that's to help others. That is how you can create a framework where you can assess. Our forward framework is to assess God's calling. Why are you here? What is your purpose? What resources do you have to achieve that purpose? Time, talent, and treasure, all three. And then how can we implement and organize all pieces of that puzzle so that we can help you best achieve the goals that God has for your life? And that is what creates fulfillment.
That's good. How can somebody learn more about that or dive deeper if they want to?
Couple great ways would be to check out our podcast, right? Just listen to more of what we're talking about. I think that would start to open up your mind to thinking about things from an eternal perspective, because most of finance is very temporal. Maybe it's got how long do you work? Maybe people work for 30 years till they retire, or I'm going to live until I'm 95, or I want to give an inheritance to my kids. So I've got maybe 100-year time horizon in my mind, but eternity's forever. So the best place to start is to try to start to open your mind to the eternal. Once you've done that, you could check out our website. We've got a ton of great content, whether it's articles about kind of thinking in a faith-forward way about your money. We've got all sorts of market insights when it comes to different interviews I do on TV, that type of thing. And if you feel like you're starting to assess and starting to read books on, hey, how can I discover my calling in my life? Something like Jamie Winship, Living Fearless, would be a great starting point to start to think about, how did God make me and what did he make me to do? And once you've kind of start to gain education in that space, if you feel like you align with how we go about things on our website, carixhq.com, you can learn a lot more about the specifics of how we help people with that mindset implement around their finances and be good stewards. And there's plenty of a pretty simple path to getting in touch with us and having a further conversation about a partnership. That's it for today. Thanks for watching. If you'd like to learn more about your faith and your finances connected, check us out at carixhq.com, or look in the show notes and you can sign up for our monthly newsletter where we talk about the markets, stewardship, and all things finance.